Can you imagine earning $60,000 from dividends? Many of us could only dream of getting that amount of passive income, but it does happen, and some make much more than that. Now, this article says that a 44-year-old earning $60,000 annually in dividends says he's still grinding and not spending much as he relies on these 8 investment picks. So we are going to see what his 8 investment picks are, and I'm going to provide my very strong opinion on his investment choices, as his strategy is very different from any I have seen, and I think you will be able to take a lot from this as a dividend investor or if you're considering a dividend-focused portfolio. So following this first rate cut that the Fed did, dividend stocks are gaining ground, and an analyst said recently that he prefers dividend stocks with decent yields and attractive valuations. And yes, I agree 100% with that. The dream, the goal is to make enough passive income you can live off of and not live paycheck to paycheck. We hear plenty of success stories, and you can be one as well, but make sure you do it in the right way. So that's what we're going to see if this 44-year-old is doing just that. Is he doing it in a right way where he has decent yields and attractive valuations that he's investing in? Shall we say quality investments? Let's take a look. So the article starts off by saying about 2 years ago, someone shared their detailed dividend income report on the community on Reddit, a dividends community, saying that they reached about $60,000 in annual dividend income with their portfolio yielding 9%. Now, my current portfolio, its yield on cost is about 2.45%, so very far from his 9%. It goes on to say almost the entire portfolio of the investor was allocated to dividend ETFs. So this investor said, "My money is in closed-end funds primarily, so I try to understand them before I invest in them." Now, let me just say this. You don't try to understand something that you're going to put your hard-earned money into. You want to understand it. You don't have to be an expert necessarily, but you need to understand where you're putting your money. He goes on to say a lot of these investments use leverage. I also do not like that. Now, this means that they got hit this past quarter with the increase in rates, and he says, we'll see long-term how that plays though. We are going to see today just how long-term these investments have played over the last 5 years. So stay tuned. That's going to be very interesting. The article says the dividend investor said the total worth of his portfolio was about 1.1 million with about 600,000 in high dividend investments. Now, the investor was asked how he could save this kind of money for his investment. Here's what he said. He said, "I started around 21. So I'll give him that. Starting early is key." He also says, "I've been saving and working in tech." Now, tech the last 5+ years has been paying good, so I can see he's probably getting a lot of his money from that. He also said, "I got lucky on a couple IPOs and a house sale." Now, yes, if you sell a home, you're going to get some good money for that, but houses are also an investment. So I think it depends how you look at that. I don't think I'd necessarily sell my home to just put it all in investments and then rent somewhere where rent's uncontrolled by me. I'd rather have something fixed, something that I can control. He says, "So it really wasn't a steady thing. I didn't miss on my IRA or 401k contributions, but that is a separate account with about 500,000. So he has the 1.1 million plus the 500,000 in his retirement accounts. Now, this dividend investor got a lot of appreciation on Reddit for generating such a high yield from his investments. However, he repeatedly said he's setting higher goals for himself and trying to save more." So good for him. And he said, he quoted himself saying, "But there needs to be much more before I can take my foot off the gas. Still grinding and not spending much. My wife drives a 2015 minivan. I will say, my vehicle's a 2015 model. It's paid off. That's a good thing." He says, "We don't take fancy vacations." And I'm going to stop right there. I think you should have experiences in life. Now, you don't have to have fancy vacations, but you can do good vacations. Like I went to Hawaii recently, but I did it in a way where I spent probably a fraction of the cost as others. I even did a video on it. So there's a way you can go to those highly sought after destinations, but do it for a fraction of the cost. He also says eating out is generally Chipotle, Chick-fil-A, and Tijuana Flats. Now I'll say here, if I'm going to go out to eat, those places are still expensive. Fast food has gotten pricey. I'd rather spend a few more bucks and eat at a sit-down restaurant like Texas Roadhouse or something, somewhere where I think there's better quality for your money and you're only spending a little bit more. It's ridiculous how expensive fast food has got. The article says a lot of people grilled the investor on being too worried about his spending and urged him to take it easy and live his life. In response, the Reddit said that he was not frugal. He said, I have a new house on half-acre land. I'm going to stop right there. So he sold a home, but then bought a brand new house on a half-acre land. Almost seems a little fishy here, but I'm not going to question it. Hopefully this guy's telling the truth on this. But where did you get that money, right? I thought you put it all in investments. He says, my cars are paid for. That's a good thing. He says, we go out to eat when we want. I wouldn't say you go when you want. Just treat yourself once in a while. He said, I buy and build new gaming PCs every 2 years. We just don't do the expensive versions of those things. Although last year he splurged and got the 3080 instead of the normal 3060 that he purchased. I'm not sure what that means, but he does splurge here and there too, which is fine. I think you should treat yourself once in a while. Then the article goes on to say there are about 20 dividend funds in the portfolio of this dividend investor. So what we're going to do is take a look at the biggest funds in this high yield portfolio, and we're going to look at the details of that fund and then its performance over the last 5 years. So let's start with the first one he has. It's the Global X Russell 2000 Covered Call ETF. The ticker is RYLD. Now this was the biggest holding that makes up that 60,000 dividend. It makes up the bigger chunk of that. And RYLD generates income by selling call options on the small cap heavy Russell 2000 index. The ETF yields about 12%. That's really high. Being a covered call ETF, RYLD is also not risk-free as often posts losses during down markets. The ETF is now in the limelight as analysts believe small cap stocks will be among the top beneficiaries of an easing monetary environment. Now, if we look at the last 5 years of this investment, it's down a massive 34.47%. That is not good. You're losing your principal, the amount that you invested, your cost basis. Not only that, but this has a high expense ratio. They're all going to be in that orange, horrible handwriting that I have circled as well, but it has an expense ratio of 0.63%. You want expense ratios to be below 0.1. If they're a passively managed fund, now if they're actively managed, maybe you can go up to 0.5. Anything above that's ridiculous. Do not pay that. That eats at your profits, your returns long term. So I would say right here, I don't like this one. It's also a little bit complicated. I don't know much about these call options. And I just think that's something that when he says he tries to understand them, I don't think he's really truly understanding these, because if you did a little bit of research and saw the performance of the stock and started looking into it, and especially with small cap stocks, which are even more of the riskier type investments instead of well-established large companies, this one, I'm going to say no. It doesn't pass the test for me. I wouldn't invest in this. The next one is First Trust Energy Infrastructure Fund. Now it says that this fund, FIF is the ticker, was the second biggest holding of the Redditor when he shared his portfolio details a couple of years back. However, in May, this fund merged with First Trust Exchange Traded Fund, VIII, so it became EIPI. So when we look at the stock chart, we can only go back to May, and it's up 4.27%. If I had to bet, the old FIF fund probably was at a loss, but I won't say that, and maybe we'll just take this one out. But for now, what I do want to focus on is that 1.1% expense ratio. That is ridiculous. Above 1% definitely should not have. That's going to eat at your returns. Don't do that. This one also I do not like. The next one is Western Asset Inflation Linked Opportunities and Income Fund. Man, even the title itself is complicated. So about 7% of the Redditor's portfolio generating the $60,000 in dividend income per year was allocated to the Western Asset Inflation Linked Opportunities and Income Fund, WIW. The fund primarily invests in U.S. Treasuries. It yields over 8% and pays monthly income. So if we look at the stock chart over the last 5 years, it's down over 20%. You're better off just investing in Treasuries because at least you get your principal back. So this is ridiculous. Why are you doing this? Now, I didn't put the expense ratio on here because I want to show you this. This is for this fund. Now, you can say the management fees, which are those first two added together of 0.73%, are high. But when you add in the interest expense, the income tax expense, the gross expense ratio is 4.10%. Yikes is all I got to say. I would definitely not look at this one ever. This one to me is a fail. Let's go on to the next one and hope it gets better. This one is Quadratic Interest Rate Volatility and Inflation Hedge ETF. About 6% of the portfolio of the Redditor earnings of $60,000 in annual dividends was allocated to this fund, IVOL. The fund invests in treasuries and interest rate options, helping investors hedge against fluctuations in interest rates and inflation. Roughly 80% of the fund's portfolio is invested in Schwab's U.S. TIPS ETF, which tracks the total return of an index composed of inflation-protected U.S. Treasury securities. You guys got that? You understand it? Great. No? That's what I thought. He probably doesn't either. So this one over the last 5 years is down over 25.5% and has a high expense ratio of 1.02. Again, another fail. Let's move on. All right, look at this title. Eaton Vance Corporation Tax Managed Global Buy Right Opportunities Fund of Beneficial Interest. Are they writing a book in the title here? So this says that this fund, ETW, invests in U.S. and international stocks and generates income by selling call options on a portfolio of its holdings. It's a tax-efficient fund as it minimizes taxable distributions through its option strategy and managing the timing of stock sales. Apple, Nvidia, Amazon, and Microsoft are among the fund's top holdings. So this one should do well, right? Any fund with these is doing well this year. Let's see how this one's doing. Nope, it's down almost 9.5% over the last 5 years. And its expense ratio is an extremely high 1.11%. This is ridiculous. You're better off investing in those individual companies or in S&P 500 ETF that holds those, that has gone up massively this year. Over the last 5 years, you would have made a lot of money that way. This one fails. On to the next. The next one is Eagle Point Credit Company, Inc. So ECC is a publicly traded fund that primarily invests equity tranches and collateralized loan obligations, CLOs, which are high-risk, bundled leverage loans from companies with limited credit access. These are high-yield, high-risk investments. I don't like the sound of any of that. And if we look at the past 5 years, my goodness, it's down 42.5% with a staggering 2.28 expense ratio. Yeah, I don't think this Redditor really does know what he's doing here. He tries to understand it, but I don't see how you would ever choose a fund like this. The next one is Cohen & Steers REIT and Preferred and Income Fund. So this one makes up about 2% of his total investments, and this one generates income by investing in real estate stocks. The fund also invests in fixed income, including debt and preferred securities of companies operating across diversified sectors. The last 5 years, it's done better than the other ones, but it's still down 4.63%. You have not made money in 5 years on your cost basis, on your principal. And the expense ratio, 2.72%, ridiculous. Knock this one out. Don't even look at it. All right, let's keep trying. I think we got one more. Yes, so let's see if this one might be the winner. Nuveen Real Asset Income and Growth Fund. Now, JRI invests in real estate stocks and fixed income securities. Its portfolio consists of common stocks, preferred securities, and companies' debt involved in infrastructure, facility services, and REITs. All right, the last 5 years, nope, down 23.5%, a high expense ratio of 1.37%. So here's the issues with these funds. They're complex and hard to understand. He tries to understand them. You don't try. You make sure you understand something before you invest in it. And obviously, all these funds are in the red over the last 5 years. That's 5 years of wasted time, of your wasted money that you've earned. Another issue is the fees on these funds are outrageous. They're ridiculous. That's going to hurt your long-term returns. That's something you don't want to have happen. You want all of those returns. You want to squeeze as much as you can back to yourself. Another issue is dilution. Too many ETFs, that means you're investing in a lot of variety. And what that does is instead of investing, let's say, a handful of companies, if that one company takes off, it's going to go up big in your portfolio. But let's say you have these 8 ETFs, and let's just say they all are, ETFs out in the market that have these companies in them. You might move up 1% or 2% because each fund might allocate 1 to 2% towards that company. So the dilution is a problem here. The other issue is these super high yields usually come at a cost, depreciating your net value of your investments. Not enough dividend income to make up for a loss if you were to sell. So right now I'd say he's probably sitting at an unrealized loss. If he sold, it would be a realized loss, and that's including dividends. Your total returns are probably negative here, and we saw those 5-year charts to pretty much prove that. We just don't know the details of his portfolio, but I can bet it's probably in that scenario. So increasing your net worth matters. You want to increase your net worth. Let's look at a fund that many invest in, that you could simply invest in, and that's an S&P 500 fund, and outperform the majority of investors. So if we look at VOO, this is an S&P 500 ETF. Over the last 5 years, it's up 93.38%. You almost doubled your money in 5 years, where the other route, you're losing massive money. Your principal, the money that you put in there, your cost basis, not a pretty story versus this, which you'd be very happy and pleased with. Now, the last issue I see is with that high influx of annual dividends, you're going to be paying a lot of taxes, so it's something to keep in mind. So these are leveraged, high expense funds that are very risky and almost all have been horrible performers. So you want to instead strive to invest for total return, dividends, and stock appreciation. Do that by choosing quality investments with healthy financials, low payout ratios, growing free cash flow, etc., etc. I cover all these often on my channel and more, so be sure to subscribe to learn how I choose quality investments, and the proof is in my portfolio. Right now, I'm up 27.67% in the green. You'll see there my yield on cost is 2.44%, not the 9% he has. And you'll see some really good investments. Microsoft up for me 75%, Amazon up almost 67%, S&P Global up 44% almost. I mean, I could go on and on. Some of these are newer, like health equity, so they still have to get their footing down and grow. But I understand these companies. I understand these investments. The only one that I will say is the loser is Warner Bros. Discovery, but I got that from a mistake of buying AT&T. It was a spinoff. I'm working on getting rid of this one. I got rid of a lot of my other losers, and it's been very beneficial for my portfolio. But yes, this is a winning portfolio in my opinion, and this is the reason why you should follow people that practice investing in quality companies, someone that continuously learns and is going to share the good and the bad with you so you can learn too. So let me know your opinion on this investor's high yield strategy. For me, I think it's something you should avoid. It's something that will lose you money. I think there's very few scenarios where it could be beneficial, but it's very slim. I just don't think it's worth it. But let me know if you would risk investment like this, a strategy like this, or better yet, you choose quality companies that have been established, have paid growing dividends over time, have those low payout ratios, etc., like I talked about. So that's all for this episode. We'll see you soon on Mark Arnold's Finance.